Hi, my name is Hunter Latown. I am a licensed realtor and associate broker in New Hampshire, Maine, and Massachusetts. And today we are going to be discussing all things appraisal and all things appraisal gap in a real estate transaction. This is great information whether you are a buyer or a seller, as having a thorough understanding can help you navigate either side of a real estate transaction. As always, there is no substitute for a personal consultation, so always consult a realtor or an attorney before making a major decision in the real estate world. All right, let's get started. So, what is an appraisal? An appraisal is the act of finding the value of a property in a real estate transaction. Typically, it is conducted by the bank or the lender who's writing the mortgage for the buyer. The reason for an appraisal is to protect the bank. If the buyer of the home defaults on the loan, meaning they fail to pay it, the bank needs to be able to sell the property and make that money back. Therefore, an appraisal is to confirm the property is worth what it's being purchased for. Let's walk through a step-by-step scenario. A buyer writes an offer to purchase a home for $500,000. The seller accepts that offer. Like most buyers, they do not have $500,000 lying around, so they need to take a loan from a bank or a mortgage lender. The bank needs to protect itself, and they send an appraiser to confirm that the home is actually worth that $500,000 that the buyer is requesting to take out as a mortgage. So, what is an appraisal based on? It's a compilation of many factors at the time that it's completed. This includes recent comparable sales of homes that are similar in the area, the condition and the features of the home, and the appraiser's opinion. So, an appraisal is not the same as the market value, and it is not the same as the tax value, and it should not be confused with those two terms. In an ideal situation, the appraiser will find the property to be worth at or more than the offer price / the purchase price. So, what happens if the property is worth more? If you're the buyer, it means that the loan can be fulfilled on the basis of the property's value, and it also means that you possibly have got a good deal on the price. If you're a seller, it means that the buyer is paying less for the home than the bank found it to be worth. It depends on your offer contract, but in most situations, you do not have any recourse to try and raise the purchase price at that point. Both parties need to remember here that an appraisal is subjective. It's the bank's safety number. It is not a definitive answer to the value of the house, and it shouldn't necessarily be treated as such. Now, what is an appraisal gap? An appraisal gap, it's the difference between the appraised value and the offer / purchase price, specifically when the appraised value is lower. Let's look at this scenario again here. So the appraiser found the house to be worth $490,000, meaning there is a $10,000 appraisal gap. Now, remember, this means the bank is only going to accept that the property is worth $490,000. They will not write a loan for more than that. So therefore, the buyer is going to need to come up with the additional $10,000 in cash if the seller is still going to get the $500,000 that they agreed on. Cash here is just used to mean monies that are not borrowed, so such as, from a savings account or an investment account. Doesn't mean literal wads of cash. So seller Q&A, does an appraisal gap mean I will not get the offer price that I have been promised? Typically, in most purchase and sale agreements, you as the seller are still owed the agreed upon price, unless for some reason you've accepted an offer that states otherwise, which is possible, so consult your agent. However, to protect yourself from the buyer being unable to make up that difference, make sure you've consulted with your realtor. But essentially, unless you agreed otherwise, a low appraisal does not automatically mean that you have to take less for the house. When and how can I be protected from a potentially low appraisal? We're going to get to discuss the when you should in a moment, but your best protection comes in two forms. So the first would be buyers purchasing in cash or with a large down payment, or having an appraisal gap clause included in the contract, which essentially means that the buyer will contractually cover the difference in cash if one arises. Should I just have my house appraised before listing it for sale? I really don't think this is necessary. As we discussed, an appraisal is subjective. It's very technical. It's sort of clinical. It's not the same as a market evaluation. However, if it is a major concern, it's likely not an issue to do so, but you will have to pay for it. And keep in mind, if it comes in lower than what you plan to list the home at, that might be an issue for some lenders or buyers should they learn about that recent appraisal. So let's discuss now how an appraisal gap works with a buyer's down payment, because this part is very important. A down payment, of course, is the required cash that a buyer needs to qualify for a loan. So there are lots of different loan programs, all of which have different requirements, including things like the credit score, income limits, and of course the down payment size. These are just three of the most common loan types that you're likely to encounter as a buyer in the real estate market or as a seller. So first of all, why would a buyer opt to put more down than the minimum requirement? So there's a lot of reasons, but they include being able to get a lower monthly payment because you have taken out less of a loan, not needing to pay private mortgage insurance, which is an additional monthly cost that's required when you put less than 20% down, or just reducing the overall cost of the loan by paying more upfront versus more that you're going to have to pay interest on. So regardless, each program has a minimum down payment that must be put down. So let's look at an example here. So the purchase price on the offer contract in this example is $500,000. For their loan, this buyer is planning to put down 5%, which is $25,000. Therefore, they need to take out a loan for $475,000. The bank sends the appraiser out and they find that the home is only worth $490,000, meaning that the bank is only going to lend based on a value of $490,000. So there's a $10,000 appraisal gap, and the buyer also still needs to put down that down payment. So what options does the buyer have to cover that $10,000? First would be to bring more cash to the closing table. If they have $10,000 available, they would add that to the funds that they're already bringing, that they're already responsible for, such as that down payment and their closing costs. The second option would be to alter their down payment. So let's say in the scenario, the buyer wants to put down the 5%, but their loan would actually allow them to go as low as 3% for the minimum down payment. So here, the buyer could then change their down payment, and instead of doing 5%, which is $25,000, they could do 3%, which would be $15,000, which lessens it by $10,000, essentially putting $10,000 back in their pocket that can now be used to cover the appraisal gap. This might result in a slightly higher monthly payment, but it means the buyer did not need to have or bring any more cash. This can be applied to a whole range of down payment sizes. For example, buyers and sellers, where the buyers are putting large amounts down, such as 15 to 30%, sellers and buyers likely don't need to worry about appraisal gaps because there's already so much built-in coverage based on the sheer size of the down payment, and thanks to it being so high above whatever that minimum required amount is going to be. So buyer Q&A now. First up, does offering an appraisal gap make my offer more competitive? So the short answer to this is oftentimes yes, it does. You want to put yourself in a seller's shoes here. They accept an offer, and then it likely takes a few weeks for the appraisal to be completed. And at that point, a seller does not want to find out that the appraisal came in low and the buyer is either unable or unwilling to cover that difference. So now that seller might have to choose between accepting less for the property or finding a new buyer, which is going to take time. It's a huge hassle, especially if they, are on a time crunch. If you're a buyer in a competitive market, using a loan with a lower down payment, I definitely recommend that you at least discuss this option of including an appraisal gap in your offer with your agent and with your loan officer. I personally have had many buyers win offers and win houses using this strategy when otherwise they just wouldn't have. Question 2, what if I do not have more cash and I can't lower my down payment? Unfortunately, in this situation, you likely just need to hope that the seller is willing to negotiate on the price. They very well may be for a number of reasons, but they're likely not going to be obligated to if they don't want to. So again, it's why it's important to have good counsel so that you've got someone in your corner helping you negotiate the situation. Last question, is a property likely to appraise low or high? So in my experience and in recent years, this video being recorded as of April 2024, most appraisals will come in at or close to the value. Appraisers understand the market is hot and prices are often rising rapidly, but it really depends on the situation and the property specifically. I hope this video was helpful to you. Check out my website for more information and education under my Knowledge Broker collection. If you're thinking of buying or selling in New Hampshire, Maine, or Massachusetts, or frankly, anywhere in the US or anywhere in the world, please do not hesitate to reach out to me. I would be happy to help you out. Again, my name's Hunter Latown, and I work with Berkshire Hathaway Home Services, Veroni Realty. Have a good one. Thanks for watching.